Hello everyone. Welcome to today's market technical analysis lesson or technical analysis lesson. And please sign up for please subscribe to our YouTube channel here. Please check out our website, stockmarketjobber.com. Anyway, I want to talk today about what we call action, or what us traders refer to as action, the action in the market. Now, action is not really something that can be quantified. It's like, just look at it this way. Say a company post their earnings and they beat estimates by a large amount, but yet the stock goes down. That's bad action. That tells us that regardless of the news, there's forces out there in the market that are more powerful. So let's just start off here with the bank sector, right? This is the ETF that tracks the banks. And I just want to show you something. One of the most important things that I teach is that certain price levels in financial markets are more important than other price levels. Sometimes we know why, and sometimes we don't. But we don't need to know why. We just need to know where they are. For example, you can see this level here with support for about a year, because this is a 3-year chart. Now notice how there was this resistance back here, right? When a market's moving higher, there's not enough supply to fill all of the demand, or sell orders to fill all the buy orders. So buyers are forced to bid premiums, and this causes the prices to move higher. When we get to resistance, there's a lot of sellers. In fact, there's so much stock for sale, or so much supply, that the buyers can buy all they want to without moving the price up any higher. A lot of times, some of these investors who want to sell start to get the sense that there are other sellers around. That's why the price isn't going higher anymore, and they start undercutting each other because they have to have the lowest price if they want the buyers to come to them, and that gets this snowball effect going. So now there's a lot of people who sold at this level who regretted doing so when the price moved higher. They experienced seller's remorse, and a lot of them tell themselves, I'm going to buy my shares back. I made a mistake, but I'm only going to do so if I can get them for the same price I sold them at. So if you have enough remorseful sellers placing buy orders at the level that was resistance, it can turn into support. So it's no coincidence that this is where this banking sell-off found support. Now, here is the same ETF, but it's just 6 months instead of 3 years. Now, this is what we mean by bad action, right? There's all this talk about how JP Morgan's going to come save the day, and we got all these cash infusions and backstop this, bail out that, whatever. Does this look like an ETF that there's been good news on? It's not really rebounding despite all this news that should be bullish. And this is a perfect example of bad action. And a lot of times when you have this bad action, well, it tells us that there's more selling to come. If the news out there isn't good enough to attract buyers into the market, then something's going on, and if there's still a lot of sellers lurking, they're going to have no choice but to push the price lower. So a classic example of bad action. Market is not acting the way you would think it would in conventional times or conventional wisdom, right? Considering all the talk of the bailouts and so forth and so on, you would think that this thing would look like, oops, oh, sorry, I'm just trying to get my pen here. You would think that this would look like this, right? But it doesn't. It looks like that. So this is what we call bad action. It's a classic example of it. At least I think so. Okay, now let's go take a look at First Republic Bank, which everyone's talking about. Now, does this look like a bank that's being bailed out? Not to me. If it was going to be a successful bailout, my guess is that the price would have rebounded, but it hasn't. So we're kind of going a little bit lower by each and every day here. All right. All right. Yeah, so we got this big sell-off. There was talk of, this bailout. We reversed kind of a little bit, but then we went right back down, and we're trading near the lows of the recent range. So this is another example of really bad action. There's been some what in theory should be good news, but the market's not interpreting it like that. So the last thing I want to look at is the financial sector. Now, this is the broad sector of all financials. The banking part is just an industry within the sector. But again, we see that there's really no kind of a rebound. And despite this basically a crash almost, I mean, you can certainly say FRC has crashed. There's just really no kind of a rebound. Now, their next support probably going to be down around 29.70. Support is when a market is going lower, right? The sellers can't find enough demand, so they have to offer their shares out at a discount. When we get to a support level, well, there's a lot of buyers. They can take in all the shares, and the buyers start to get the sense that there are other buyers around, and they step ahead of them to bid higher prices. Because if you don't have the highest price, if you're not willing to pay the highest price, the seller is just going to go to someone else. And we get this snowball effect here. This chart illustrates a pretty cool principle of financial markets, which I will tell you about before I get going. Support can turn into resistance. Resistance can turn into support. How does this happen? Well, there are people who bought here who regretted doing so when the price went lower. So they tell themselves, I made a mistake. I'm going to get out if I can, but I don't want to lose any money. So if the price gets back up to where I bought it, I'm going to place my sell order. So if you have enough remorseful buyers placing sell orders at the level that was support, it converts into resistance. Over here we have remorseful sellers. People sold here, the price goes higher. A lot of them regret selling and they tell themselves, I'm going to buy my shares back, but only if I can get them for the same price I sold them for. So if you have enough remorseful sellers placing buy orders at the level that was resistance, it can convert into support. And then we can see it converted back into resistance here. So I spent over 20 years in the institutional trading world, and so I can speak with firsthand knowledge as to what goes on. And I'll tell you this is the type of stuff that the good traders pay attention to, right? What we're looking at here is a measure of psychology. Buyer's remorse, seller's remorse, buyers getting anxious that they're going to miss out, so they bid higher prices. You have to look at a chart through the context of what does it tell us about supply and demand, and what does it tell us about psychology. Like, for instance, the bad action, that's the psychology thing, right? This is even why one of the reasons why gaps form. When we know that we get support from remorseful sellers placing buy orders, when we gap up through these levels, there are price levels it just doesn't trade at. So if it didn't trade there, well, there's no one there to sell it. So you're not going to have remorseful sellers placing buy orders on the way down, and then we just come right back in, right? It says rip higher, rip lower. So yeah, so the institutional traders, we don't pay attention to things like Fibonacci or Elliott wave or any of that stuff. So to me, that's science fiction. But we pay attention to what levels are important, what's the trend, what's the momentum, and what's the psychology. All right, thank you, everybody. Hope to see you soon. Please make sure you subscribe to our YouTube page here. Thanks.